There are lots of multifamily investment opportunities out there, but how do you know which ones are best for a passive investor from a passive investor point of view? In this video, I'm going to cover 4 investor-friendly terms to look out for in an offering. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about 4 investor-friendly terms to watch out for. And the first term to watch out for is the type of equity being offered. Now, I've done videos in the past talking about waterfalls, hurdles, and the capital stack, and I'll put links right up here to those videos where they go really in depth on those specific topics. But what I mean by the type of equity offered is we really have 2 types of equity in a multifamily syndication or a fund. And if you're just getting started and you're not sure what those are, I'll put the link right up here to that video. So we have 2 types of equity. Number 1, we have common equity. And then the second type of equity is we have preferred equity, or sometimes this is called pref. In the capital stack, not to go too in depth or too crazy, we have at the top we have common, and then underneath we have pref. And of course, as we know, the lower down the stack you go, that's who gets paid first, and then the risk is higher the more you go up the stack. So how does this relate to equity? Well, if you are being offered as a passive investor common equity only, there's no preferred equity, your equity is the same as the sponsor's equity. So you guys are getting paid at the same time. But if they are offering you preferred equity, you are actually going to get paid out before the sponsor does. And also when we talk about hurdles and waterfalls, preferred equity comes with that. So if there's a preferred return, that means that there has to be a benchmark hit, whether it's 7%, 8%, 10%, 6%, it all depends on the deal, before the common equity can participate in the profits. This is really important for a passive investor, for you as a passive investor, because we all have to make sure that the sponsor is incentivized to perform. So if they're getting paid along with everybody else, well, there's no incentive there. But if the passive investors, the preferred equity owners in this case, if they have to hit a certain threshold before these common equity can participate in the profits, well, that's going to make sure the sponsor is working extra hard because they actually want to participate or get paid some of the cash flow being produced by the deal. And this leads us to the second point, which is fees versus splits. Now, I've done videos in the past talking about how passive investors make money in a real estate syndication or fund. I'll put that link right here if you want to go more in depth on that subject. But what I mean is we have to make sure that the interests of both parties are aligned, right? We have the sponsor, typically common equity. They want to make money on the deal. And then we have passive investors, the people bringing the capital to the mix, and they have goals. They want to make money in the deal, but how they make money is different. Passive investors, whether it's common equity passive investors or preferred equity passive investors, they make money based on splits. So if there's cash flow being produced, well, that's paid out according to a split. If there's a capital event, the deal is refinanced or the deal is sold, well, that's paid out according to a split. The sponsor, the person running the deal, on the other hand, is paid not only with splits, whether it's distributions or a capital event, but they're also paid according to fees. Now, this is where, as a passive investor, you have to be very careful about how the sponsor is being paid. Because if it's too heavy on fees, fees are paid no matter what. Fees are not tied to performance. But as a passive investor, you want the sponsor's remuneration, their paycheck, coming based on performance. Some sponsors may offer a much higher split in favor of the limited partnership, the capital investors, the passive investors, but take higher fees. But the higher fees are going to get paid no matter what. There's no incentive there. There's no alignment of interest. And we talked about this as it relates to preferred equity. So if you are a passive investor, you want to make sure that the sponsor, the person running the deal, their paycheck is basically coming on splits rather than fees. It's more heavily geared towards splits because those are going to be paid out if they actually perform and the deal is making money. And if the deal is making money, you as a passive investor are making money, everybody is happy. But let's say the splits are not very favorable to the passive investor and there's a large number of fees being paid out. Well, those fees are getting paid and the sponsor really has no incentive to overperform because they're going to get paid no matter what. And this is where hurdles and waterfalls come into play. And just real quick, I'll put the link up right here if you're interested in the video I did just talking about waterfalls. I think I made the joke about you don't want to go chasing waterfalls, but as a passive investor, you do want to go chasing waterfalls. Because let's say it's like this. The waterfall or a hurdle, it's just the same imagery in reverse. With a waterfall or a hurdle, the sponsor is actually going to get a higher split the better the deal does. So maybe in this case, until the deal hits 10%, it's on a 60-40 split in favor of the LP. But maybe once they hit 12%, it goes to 70-30. And then once they hit maybe, let's say 14%, it goes to 80-20, and you get the idea. So basically the whole idea with a hurdle or a waterfall is to incentivize the sponsor to really overperform. And when the deal is overperforming, well, you as the limited partner, you as the passive investor are having a great day because you're making a whole lot of money too. Now let's talk about number 3. And number 3 is one that a lot of people don't really think about. This often gets missed because people like looking at the dollar figures when they're looking at marketing packages and all of that, but they really miss this one. And number 3 is penalties. Now this applies to not only syndications, but also to real estate funds, especially the longer term ones. So what I mean by penalties is, let's say you invest your capital in a fund or in a syndication. And let's say it's a 7-year hold in a syndication, to use a syndication example. And after year 5, a big event happens and you need to pull your capital out. Well, generally speaking, what I tell all my investors that, when you're investing in a syndication, that money's locked up for the full hold period. You should forget about that money and just focus on collecting the paychecks from it as your money goes hard at work inside the deal. But what happens if something really bad happens and you need that capital out? What sort of penalties are you going to be faced to retrieve that capital from the deal? Now, this is where you have to strike a balance because as a limited partner, as a passive investor, you don't want every passive investor pulling out their money early on the deal because then that's going to leave the deal undercapitalized, underfunded, and that's never a good situation. But if you really, really, really need to get your money out, you need to know what sort of penalties. Are you able to sell your shares in the deal to another passive investor in the deal? Are those the only people you're able to sell your shares to? Does the sponsor get first right to buy your shares? Is there a discount you must sell them at? And does that discount decrease every year into the deal? So maybe you're selling at a big discount to the sponsor in year 1 to 3, but maybe that lessens in year 4 to 7. There's so many different ways to do this, but you really have to focus on this because the one thing I always say is you want all your surprises up front. So think about the worst case scenario up front in the slim chance that it does actually happen down the road. If you never even think about it and a big catastrophe happens, well, that's when you're scrambling and you're not in the right headspace. So you always want to be making your investment decisions with a cool, calm mind, and make those up front when you're reviewing the deal documentation, and don't wait until something bad actually happens to say, I wonder how I can get my money out. Think about this stuff up front. Now, in the case of a real estate fund, it's the same thing. At what point can you get your capital out if you really have to? Are you really locked in for the first 5 years? Or are you able to, in some cases, are you able to pass on your shares to a family member if you die at some point during the hold period? That's something that comes into play. Are you restricted on who you can bequeath your shares to? All of these things come into play, and you should be asking these questions at the point of you deciding whether or not you want to invest. And term number 4, investor-friendly term number 4, are minimums. Now, I'm going to take a slightly different approach to minimums because lots of people, they think, well, I just want to invest in a deal where the minimums are really low. Maybe it's a $50,000 minimum. I'm just going to look for those deals because I don't have to put a whole lot of capital in. I'm going to suggest you think about it another way. You don't want too many cooks in the kitchen. Now, of course, passive investing, limited partners, they're not actually telling the head chef what to do because they're non-voting shares. They're along for the ride. But you don't want too many people involved in a deal, because think about it from a passive investor point of view. Do you want the sponsor focusing on, let's say, 30 key investors in the deal where you're getting a really good feedback about how the deal is performing, you're getting regular updates? Or would you rather have 130 people in the deal at smaller amounts where the sponsor's time is more spread out and you're probably not going to get the same types of updates or communication from that sponsor? So again, like when it comes to minimums, lower isn't always better. I would much rather see a smaller pool of passive investors in a deal because there's less people there. It's a little more tailor-made. There's a lot better communication in that respect rather than just sheer numbers. So as a passive investor, yes, you want minimums that aren't outrageous. So you don't want a $500,000 minimum. Well, maybe you do depending on the deal, but as long as it's reasonable, but it does ensure that there's not a whole flood of passive investors in there and everybody has enough skin in the game, and that's going to keep everybody focused on the end result, which is acquiring a good piece of real estate with a solid business plan and making that happen, and then earning all the tax benefits, the cash flow, and the appreciation that comes with owning multifamily real estate. So those are the 4 key investor-friendly terms to look for. And if you are interested in learning more about multifamily real estate, join my Facebook group. Link is right down below. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.